Hi, welcome to my channel where I share with you ideas to help you make better financial decisions. So in today's topic, I'm going to cover this. Is the STI Index a good investment? I have seen a lot of people giving advice that you should just invest in an ETFs and just diversify across all different companies across the countries, and generally after 10 years or 15 years or so, you should be able to get pretty decent results. But what I am going to show you is going to shock you. So let's get down to the details. Okay, so before we dive deep into what is the STI ETF, so let's talk about the STI Index first. So for the STI Index, it is basically made up of 30 companies in Singapore, which are all listed companies on the SGX, and you can actually find it over here. So actually take a look at all these companies. Okay, there should be actually in terms of a total of 30 companies, but as of now, under this website in Yahoo Finance, they actually show us the top 10 holdings, which includes names that you are very familiar with: DBS, OCBC, UOB, Singtel, Jardine, Ascendus, yeah, all these companies. So they don't need too much introduction on this. So an STI ETF tries to mimic the movement of the STI index. So if you are invested in the ETF, you are actually invested in a basket of companies. What are the benefits of doing so is that you actually can make it very passive. Secondly, you do not have to spend a lot of time to research on individual companies that you would like to invest in. And the third thing is that your investments is already diversified, and ETF is also a low cost way of doing your investing. But is the ETF really that good? So let's talk about the downside. Okay, so the first thing that I noticed regarding about the STI ETF, under this website, you can see that majority itself, right, in terms of the breakdown, the fund sector breakdown over here, mostly 61% is actually in the financials, then a bit of industrials, telecoms, consumers, oil and gas. In terms of weightage, right, this is already one huge flaw that we are looking at, because the whole fund is actually skewed towards one sector, which are financials. So if we look deeper into things, basically you can go back to this site that we can see is that the top few funds are DBS, UOB, OCBC. These are actually the three main players in terms of the financials. And the second issue that I see is that the quality of the companies that are in the index. Ultimately, most of them, they are blue chip companies. They are pretty big companies with strong balance sheets. But in today's market, where things change so fast and companies are facing disruptions, it seems that most of the companies listed in the STI Index are not innovative companies, but companies that are pretty, I would say, old school. So even in terms of banks, telecoms recently, I think Singtel also took a hit with the drop in performance on their latest updates. So what we want is that we also want the companies to be of good qualities, that are innovative, that can be prepared to perform for the next 5, 10, 15 or even 20 years. And the last thing I would like to say regarding about the STI Index is actually the last 10-year performance. So what I am going to show you is going to shock you. So with regards to this STI ETF, let's take a look at their performance for the past few years. So year 2015, 16, 17, 18 and 19. So there are some exceptional years that they actually perform pretty decent. But if you are investing, most likely you want to invest for a long period of time for your retirement. And if let's say we are taking in terms of a good 10 years result. So over here I have generated the return of this ETF from 2010 June to 1st June to 2020 1st of June. So the results itself for the past 10 years, right, this actually in terms of cumulative return, the fund actually returned a negative 7.14% even after investing for 10 years. The performance is still not something that is left to be desired. So there are a few takeaways from here. So first of all, when you actually read news from the media, blogs or from any sources, do your homework to actually study deeper into the figures and numbers to ensure that you are receiving the right advice and the advice is actually applicable for you. Second thing, don't invest due to familiarity, because I notice a lot of investors in Singapore, they tend to stick to the Singapore market because they find that these are companies, they are something that is very familiar to them and they feel safer due to the familiarity effect. However, if you think about it, if the ETF is highly skewed towards banking, and banking industries, I believe in the next 5, 10 or even 15 years down the road, I believe you have already seen the papers regarding about the disruptions in many different industries. So will banking be the next? So with the upcoming blockchain technology, it might not. But who knows? So explore the market outside. So don't just stick to a market that you're very familiar with, and try to explore something that might be able to give you a bigger potential of return for your money. And the third thing, they say ETFs are cheap. So if it's cheap, it's good for you. So in this case, cheap doesn't mean good. Results means everything. So I hope you have learned something new in this video, and I look forward to talking to you in the next video soon. And if you enjoyed this video, I would appreciate if you are able to smash the like button. It will help me to share the video and spread the message to more people. Thank you very much and goodbye.